Hi everyone, welcome back to my channel. Taking tax benefits from business losses is the subject of this video. I don't want to put a damper on your new venture, but most businesses lose money during the startup phase. Fortunately, the tax code softens the blow for people who lose money in business. The amount of tax relief from Uncle Sam, however, depends on things like whether your business is incorporated and whether you're active in the business or just an investor. As usual, rules for unincorporated business losses are different from incorporated business losses. Owners of a sole proprietorship, a partnership, an S corporation, or a limited liability company can claim their business operating losses on their annual Form 1040 individual tax returns. This is called a NOL, or net operating loss. It simply means a business's deductions are more than its income. An NOL is used to offset other income, which usually results in a tax savings. However, an NOL cannot reduce a person's taxable income to below zero. Instead, the law allows unused NOLs to be taken in future tax years. This is called an NOL carryover. Now here's an overview of NOL carryforward. An NOL is first taken to offset your other income in the year it occurred. If the loss exceeded your other income for the year, you used to be allowed to amend your tax returns for the prior 2 years and get a tax refund. This is called an NOL carryback. An NOL carryback is no longer allowed under the Tax Cuts and Jobs Act. If there is unused loss, you can carry the loss forward indefinitely. The TCJA limits losses that are carried forward to the lesser of the total available loss, or 80% of a taxpayer's taxable income. This means that you can receive the benefit of business losses in future years. Attach IRS Form 1045 Schedule A, which shows how much loss is left over after the first tax year. Capital losses. If you put money into someone else's business as a loan or an investment, you don't get a tax deduction for any of that venture's operating losses. You have to be an active participant to get a tax benefit. However, if the business goes belly up, you may be able to claim a capital loss on your personal tax return. Capital losses can be used to offset any capital gains you have. For example, if you sell Amazon stock at a profit. Any excess capital loss after offsetting your capital gain can then be deducted against ordinary income, such as money earned from a business or wages. However, you can only deduct up to $3,000 in any year. Any capital loss over $3,000 can then be carried forward in future years at $3,000 per year until it's used up. Unfortunately, you cannot carry a capital investment loss back to prior years. To have a better understanding, let's do an example. L&I invests $45,000 in Triple Z digital imaging business. The business fails, which L&I lose their entire $45,000 investment in 2015. They deduct $3,000 as a tax loss against their ordinary income in 2016. Then in 2017, L&I sells Amazon stock, realizing an $8,000 capital gain. In 2017, they can claim $11,000 of the investment loss from Triple Z digital imaging business, which is the $8,000 capital gain plus $3,000 of ordinary income from their jobs. After taking $3,000 as a tax loss in 2016 and $11,000 in 2017, L&I have $31,000 in capital losses to claim in future years. they can deduct only $3,000 per year unless they have some more capital gains in the future, like their sale of Amazon stock. On a brighter note, there may be a way to get beyond the $3,000 annual loss limitation by incorporating. One tax code provision to know by number is Section 1244. This allows shareholder investors in a small business corporation, whether active in the business or not, to more quickly deduct their investment losses if the business fails or when they sell their stock. Section 1244 allows individual shareholders to take losses beyond the $3,000 annual deduction limit that normally applies to capital losses. Section 1244 allows an ordinary loss of up to $100,000 for a married couple filing jointly, or $50,000 for a single taxpayer or married person filing separately. The loss is claimed on the shareholder's 1040 tax return, reducing or eliminating their tax bill or producing a refund. Also, any excess loss can be carried forward and claimed in future years. However, for future years, the regular $3,000 per year limit applies. Over $3,000, the loss can be used only to offset any capital gains from investments, not ordinary income from earnings. Here is an example to illustrate a Section 1244 loss. L&I buys $150,000 in stock in Triple Z, a Section 1244 corporation. Triple Z does poorly, and L&I sell their stock for $20,000, losing $130,000 of their investment. L&I have earned income of $100,000 that year, so they can offset $100,000 of their $130,000 loss on their tax return. The remaining $30,000 of the loss is called a capital loss carryforward. It can be claimed on L&I's future year's capital gains. If they don't have any capital gains to absorb the loss carryforwards, they can still claim a deduction of $3,000 per year. In this case, it takes L&I 10 years to use up the excess capital loss of $30,000. Important note: make sure your corporation qualifies for Section 1244 treatment. Section 1244 only applies if, when the corporation was formed, the total money or property it received in return for stock was less than $1 million. Your corporation must pass a resolution stating its intent to be a Section 1244 corporation when it is made. How to claim a Section 1244 loss. If you take a loss under Section 1244, you must file a statement with your individual tax return explaining the loss. If the IRS audits you and finds that Section 1244 wasn't applicable, your loss is treated under the capital loss rules. As I mentioned previously, under these rules, you cannot offset your loss against ordinary income beyond the $3,000 capital loss annual limit. Sales of Section 1244 stock between related parties are suspect to the IRS. So, if you claim a tax loss from a transaction with someone related to you by blood or marriage, an IRS auditor may disallow it. Related parties are parents, children, and in-laws, as well as other businesses controlled by you or family members. To be safe, sell stock to non-relatives. For instance, if the corporation stock you own is worthless, sell it to a friend for $1. Your friend has nothing to lose by helping you out, except $1.